And 72% of the time the market goes up. And the answer came to me. And that's what I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. I get nuts.
With your host, Phil Grande.
Bye. Welcome to my podcast. Okay, so yields are rallying big time. But the problem is they're rallying for the wrong reason. And most traders don't understand that. And that's causing a real problem. Example, when we have yields right now that are, well, let's just take I'll give it to you right now, the 10-year yield right now is at 4.60. The one you really got to watch is the 2-year. That's the killer, 4.26. That's the killer. So the problem is the machines are not human. Unlike the institutions, you have the institutional players. These guys are human. And machines aren't, so machines will just interpret signals. So what's happening is when these yields are going up, the machine, the computer, interprets the economy strong. And they start putting you in the wrong stocks. That's one problem. So in other words, just because yields are going up doesn't mean the economy's strong. Now that's been burnt into our head for years and years. Hey, yields go up, that means your economy's really strong, doing well. Well, yeah, if it's for the right reasons, but we don't have the right reasons. The reason why the yields are so high and the machines are interpreting it as good news, the economy is growing, which it's not, which complicates trading because they'll lead you to the wrong stocks. And of course, the jibber jabbers on TV will lead you to the wrong stock. They'll tell you, gee, don't be in defensive stocks, okay? Because look at the yields; they're high, the economy's strong. So let's get into, railroads or something like that. And you should, if you're a smart trader, you would. But you got to be careful. You got to know when to get out, and you got to understand if the railroads are going up, they're going up for the wrong reason. Not the economy's good, okay? They're going up for the wrong reason because of the interpretation that the economy's strong. That interpretation comes from the machines. So that is a problem right there. And the other problem we got with these machines in trading, as I said, they fade. So in other words, you buy a stock at $50 in the afternoon, you're up, let's say, $55. Well, you think I'm going to add another couple hundred shares. But the problem is when you're adding a couple hundred shares, what's happening? The stock that went from 50 to 55 is back to 50 or 51 or 52. It's always fading back because the machines don't support the trades, either up or down. So these high yields are causing a problem unless you know how to trade. What does that mean? That you understand how the system works and you understand you got to follow the money and the trend of the money. And you got to follow the yields and interpret what the yields are telling you. I mean, the 2-year yield's at 4.27. The 10 years at 4.61. 4.50 is a red flag. 3 years at 4.29. And keep your eye on that 2-year, okay, and that 3-year, because if that 2-year drops below the 3-year, then you got a red flag for correction or worse. So today what's happening is because of these machines, you got, and the jibber jabbers on TV are saying, get out of your Coke and Procter & Gamble and Clorox, get out of all your the utilities, all these defensive stocks, okay, and go buy, let's say, not truckers, but by railroads. And we bought a little bit of the railroads today too, but we also know they're going up for the wrong reason. If somebody doesn't know that, he jumps in and he's buying the railroads because he's listening to jibber jabber on TV, say, boy, the economy's strong, look at these yields. The economy's not strong. Talking about the economy is strong. These 10-year yields are really killing the mortgage industry. And, and as these 10-year yields keep going up, but you also got to remember that 2-year is really more important because that 2-year sets the rates for everything. Your credit cards, the 2-year sets the rate for credit cards, for your student loans, for your business loans, for almost everything. And most people don't understand that either. You got to really watch that 2-year because that 2 years is the killer. And when you want to see that 2-year, okay? You want to see it around, maybe 375, 384. You want to see it under 4, okay? That's what you want to see, that 2-year yield. But it's just not happening. The 2-year yield is just way too high. Then the 10-year is too high. But going back to talking about these yields, the 2-year I think right now is 4.29. No, 2 years 4.27. That's huge. And but let's go to talk about what's going on in the housing business right now. Okay. If you look at the mortgages, okay, back in 2020, it's only, 6 years ago. And a $320,000 home cost you about $1,000 and some change a month at 3%. Today, that same house, okay, that same house is costing $450,000. So you paid $320,000 in 2020. Here we are 6 years later. You're paying for that same house $450,000. But your payment's $2,405 a month instead of $1,000 and a little change, $1,079 to be exact. So these mortgage rates, we don't have, at least the one thing we don't have to worry about is a housing crash, because 60% of the mortgages that are outstanding are those people who got those mortgages at around 3%, 3 to 4%. But it's causing a crisis because people aren't selling. They're holding on to those 3 to 4% mortgages. So that means inventory is scarce. Prices are going up. But just think about that for a moment, how important mortgages are. I mean, these rates are. And these rates keep climbing. I mean, 2020, 2006 years, a house went from $320,000 to $400,000. And this is insane. $450,000. And the rate's at 7.25%. That's the your mortgage. And the mortgage comes off that 10-year treasury. And these treasuries these yields are going to keep going up for your house. And the 2-year, which is the disastrous one, because that's the one that, like I say, covers almost everything outside. Remember, your 10-year covers your mortgage. And the 10-year also has to do with lending with big corporations, stuff like that. But that 2-year takes care of everything else, and that's the dangerous one. So, and right now what's interesting, the rate is 7.25. The payment's $2,405 on a $450,000 house. Now, the people who are in trouble, and are the FHA borrowers. They're the ones that are in deep trouble. And delinquencies are really climbing, okay? And their delinquencies, FHA, are 6 times higher than a conventional loan. And the VA is worsening too. VA delinquencies are climbing like crazy. Highest VA foreclosure since 2017. So VA, FHA are in real trouble, but the conventional loans aren't, because as I said, 60% of all U.S. mortgages are below 4%. Now that's amazing, isn't it? Think about that. But it also screwed up the whole industry, and it's caused housing prices to escalate so fast because there's no inventory. So it really didn't help. That was probably one of the worst things that happened when they dropped rates that low. So and we're being pushed now. The 10-year is being pushed towards 7.25, 7.50. So that means few people can qualify, for a home, for a mortgage. In the home builder industry, the people who are selling homes, outside of the builders, they're suffering trying to sell homes, right? The builders are suffering, but not as bad, because they're the only ones that are really keeping the whole housing industry afloat, because, again, remember, they can buy down mortgage rates. That's one of the biggest things. They can buy down mortgage rates. They can give us incentives. They can control the supply and demand. They're always building smaller, cheaper homes. But they're not out of the woods by any means. Their traffic is cut by 3/4. You go to these model centers, they said traffic's cut in half, at least in half, some worse. The cancellation rates are going through the roof, and the construction costs are just going nuts. So my whole point is that these yields that are going up, that 10-year treasury is killing, the housing industry. But more than that 10-year mortgage heading the yield heading to 7.25, 7.50, what really killed it was 60% of the homes got mortgages under 4%. Now, going back to the stock market, you got to be really careful with the stock market, because, again, these machines are interpreting the market, as the economy is strong, as anything but strong. But that's been drilled in our heads for years and years and years. Yields going up, the economy's strong, buy, buy, buy. Now they're telling you to do the same thing, buy, 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 the economy. It's not. It's not. It's just the interpretation, but it's not. Now, where we're doing well is we've been buying oil, oil service stocks, and they've been shooting up, and at the same time we've been shorting their airlines. So that's one thing, you have an experience that you know what to do, is that when oil prices start going back up, you go ahead and buy the oil service contracts. And it's a good way to trade, because if oil goes up, your oil service contracts go up, you buy those stocks, and the airlines turn around, they start collapsing, going down. So that's a great way to trade. But for those people who are jumping, not going into Coke and Clorox and all these defensive stocks, and not going into any of these defensive groups, you're getting the wrong information. I mean, when you look at the stocks today, you say, but Phil, these other stocks are doing better than Coke and Clorox, especially if you take a look at all the railroads. But that's not going to be the case in another day or so. People are going to catch on and start dumping, so you got to be very careful. The tech stocks, the 4 biggest tech stocks, are really getting crushed. And we have every one of our gang members set up to short those on the Pro 2 the minute they start turning red. And because those stocks are really, if they break the 50-day moving average, and when I'm talking the stocks, I'm talking about the ASML, CLAC, AMAT, LRCX. Those are the 4 companies that make the machines, the chip machines, and then watch TSM, MU, and Intel, they're the biggest buyers of those machines from those companies. So those stocks right now are starting to fall apart. But if they start breaking those four, break that 50-day moving average, that could be a great shorting opportunity. So I'd keep my eye on that. But remember, stocks always do what they're supposed to do, but never when they're supposed to do it. So follow the trend, money trend. If you always follow the money trend, you'll never be wrong. And as long as you know how to sell short, as long as you know how to buy, but you got to know how to short too. You just can't be a buyer. You're going to get crushed. If you know how to do both, buy, sell short, understand how to follow the money with trend line, how to look at the footprint of the institution so you know what they're buying, you'll be just fine. It doesn't matter what they throw at you. And that's what we've been teaching for almost 50 years. All right, we'll see you on the charts. Thank you for visiting my show today, and hopefully see you again tomorrow. philsgang.com.